A head and shoulders formation pushes the market under long-term support from 137 that has now reversed roles to resist an early uptrend. There was also a formation from May to July that went from a double to triple top that was more concave rather than being horizontally aligned, though the candles in the three downswing points still mostly overlap in the overall mid-150s range. That later becomes the shoulder level of the head and shoulders. The big picture shows an established downtrend from major resistance. A descending trend line is comprised of clear downswings that often have high volume and clear candle patterns. This will be helpful in gauging the longevity of the downtrend in the long term. A small common gap presents expected resistance when filled. The boundary between the 130s and 140s becomes a clear short to medium term range. From that gap downfill, that also forms a double top. Quite some time has passed, but there is contact with the downtrend line that does affect the more recent uptrend that began in March. Market activity has reverted to a more neutral to bearish stance, with the trend line now providing short-term support as it and the 137.33 level reverse rolls to provide short-term support. The downtrend line from the first head and shoulders approximates the neckline of the smaller and more recent head and shoulders. That can also be outlined with closing prices alone. It is another instance where a head and shoulders reverses a short-term uptrend in an ongoing downtrend that is on a larger scale. Minor resistance from the downtrend line as it drastically diminishes in influence. This is also true for the 127 to 137 range that only manages to slow down the bullish recovery upon first contact. Going back into a close-up of the past year shows another instance of another head and shoulders that held trading into a lower range. This one was more difficult to spot, especially during its development, since it was smaller. But regardless, trend lines from the neckline are useful guides in gauging an uptrend breaking higher to continue over the 112 to 114 upper boundary. Looking at the lower 100s range from various views reveals it to be a reverse head and shoulders that reverses a downtrend and continues a larger uptrend. Here is a contrast where instead of the neckline of a head and shoulders resisting an uptrend, the neckline of a reverse head and shoulders opposes a downtrend to support the market around 113 to eventually develop an uptrend. Another head and shoulders example to start 2011, but the market soon recovers to return to the long-term uptrend. When patterns are sufficiently large, they can also be more easily recognized by going to longer timeframes, such as the weekly and monthly, as seen with the W and M in the top left corner of the past few charts. Now let's continue the case study by looking at BAC, Bank of America stock chart, during the same general time range. This can help identify some broader market landmarks seen on the previous SPY chart that represents the overall stock market, since SPY is an ETF that accurately tracks the major S&P 500 stock market index, of which BAC is one of the 500 stocks that makes up the index. Sometimes many stocks will exhibit similar behavior during major market trends, seen on large indices like the S&P 500 and the ETFs that track them. This is why certain patterns tend to be prevalent on many stock charts at certain times. Similar to the start of this case study with the SPY chart, there is a concave triple top that blurs the line between a double and triple top sometimes. It can also be the sign of a failed ascending triangle in certain instances. The clear downswing points easily mark a resistance range that happens to be part of a long-term downtrend that progresses much lower. Three methods rising candle price action in the short term to increase the chances of a double bottom completing successfully. A classic double bottom completes. Also note there can be swing points or flattened and stalling price action before and after the double bottom, which will often line up with the minor downswing point in the middle of the pattern's temporary range. Crossing a steeper downtrend line did show the uptrend starting from early 2009 had a better chance of at least holding flat instead of falling back down under $10. A minor gap downfill takes place in March during the early stages of a descending triangle. The strong support base lines up with a gap upfill shortly after the start of 2011, just after the double bottom. This delayed the descending triangle's continuation. It can be debatable whether a descending trend line from a descending triangle has to start after the initial downswing that begins a downtrend, or whether the first downswing in a downtrend can be part of a descending triangle. That is why there are two variations shown here, when the double bottom's uptrend is reversed. In any case, they both represent bearish sentiment accumulating. Descending triangles can appear at the top of an uptrend, but they can be less reliable in producing a major drop. In this case, bearish sentiment was present since the descending triangle formed within the large downtrend before the double bottom. The chart demonstrates the greater impact of the 2008 to 2009 recession on financial sector stocks, when compared to the broader stock market as represented by the SPY chart. Another double bottom with more bullish potential, due to the minor incline before the breakout that had exceedingly high volume. Also, this is a case where a double bottom forms in line with a previous downswing, to form a less strict triple bottom for even more bullish context. The bolstered bullish context was a crucial part in the major recovery, where major resistance is already identified from previous trend lines and patterns, like the descending triangle. Now the 15 to 1340 range reverses roles to become a vital support. Trading is range-bound with clear upper and lower boundaries. Resistance remains, and there is even a slight decline before the bearish acceleration. Short-term focus is directed at the 15 level. 15 fails to hold, leading to a steep downtrend into 2016. Then during a later recovery, the previous levels still hold influence as would be expected. This is especially apparent with current support from 15 again, following a minor double top earlier. The previous major range could actually be considered a head and shoulders in a more range-bound context. This kind of formation can be more difficult to recognize, directly forming the peak of an uptrend, with no upswings and downswings overlapping the same price range before the left shoulder starts. In any case, a downward slope was quite noticeable near the end. Even if the head and shoulders wasn't recognized, it is always helpful to find a major descending trend line as an uptrend begins a major recovery. Similar to other instances, there is some resistance from the downtrend line, and once it is overcome, the uptrend has a better chance of moving higher, especially in this case with the bullish spike to gap over the firm 1850 to 18 resistance range. It isn't unusual for an old major downtrend line to impact the market, though it is less common to see it conveniently lining up with a pattern. In this case, a descending triangle forms, but in a bullish context, within an existing uptrend. That has proven to be strong with the recent break over the 18 range. This is why it is less of a surprise when it fails, and another steep incline takes place. Naturally, the triangle base of 22 to 23 will still influence the market, as it does here, providing excellent support. Here's another example of a failed descending triangle. Again, it is not forming in a more advantageous situation for a bearish perspective. It is in an uptrend rather than a downtrend. An uptrend that holds firmly over the still useful 22 to 23 range. That becomes the horizontal support range. From here, a firm foundation gradually sees exceedingly high and constant bearish volume and price action decrease, while near the end of the triangle there is a noticeable bullish buildup from the end of October prior to the gap up. The gap up is not immediately filled. That means the uptrend is strong like in previous examples. As well, similar to previous examples, the gap up is at the site of an existing area of significance. In this case, it is around the upper portion of the triangle in the 27 to 28 resistance range. This is helpful in defining the gap up zone in combination with the large green candle.